Your US sales are increasing, then the payout lands in your UK account, and somehow the margin looks thinner than your management account suggested. Most founders blame the 2% payment fee, but that's not the whole story. I'm Carl from KKG Accountancy. We look after the numbers for e-commerce founders. Your US sales are increasing, then the payout lands in your UK account, and somehow the margin looks thinner than your management account suggested. Most founders blame the 2% payment fee, but that's not the whole story. That same dollar often gets converted twice, once by your payment provider on the way in, and once by your bank on the way back out to pay your supplier. Quick test: if more than a quarter of your sales or your costs sit in a currency that you don't actually file in, you could be affected. One underlying question most founders rarely consider is, which currency does your business actually operate in? The accounting standards separate two ideas. Your functional currency is the currency of the world you really operate in. Broadly, the one that drives your sales prices and your costs. Your presentation currency is just the one you file in, which for a UK company and company's house is normally pounds. And here's the thing, they don't have to be the same. A British registered brand that prices in dollars, sells in dollars, and pays its factories in dollars might generally have a dollar functional currency, even though it files in sterling. And this distinction decides whether your FX noise lands in your profit and loss or not. If you treat pounds as functional, every dollar balance is a foreign item that gets retranslated at year end, and that movement runs straight through your profit and loss and into your tax. If dollars are generally functional, those same balances aren't foreign at all, so most of the FX volatility disappears from your profit. What remains is just the difference from translating your dollar results into sterling for filing, and that sits in a separate reserves account rather than hitting your profit. For most founders, the answer will still be sterling, but it should be a decision your accountant has made and documented, not just assumed because you happen to be UK registered. Under FRS 102, your foreign currency monetary items, your dollar debtors, your dollar creditors, your dollar cash, have to be retranslated into pounds at a closing rate on your balance sheet date. And under corporation tax rules, CTA 2009, sections 328 and 483, the resulting gain or loss is brought into your tax computation as it accrues. So there's a real tax consequence attached. Now, where does it actually cost you? Two places. The first issue is double conversion. You let your payment gateway auto-convert your dollar sales into pounds the moment they land. That's roughly a 2% spread. Then a few weeks later, you owe your supplier in dollars, so your bank converts those pounds back into dollars to pay them. Another 2.5%. You've crossed the same currency border twice and paid a toll both times. On a £500,000 brand, that round trip is somewhere around £8,500 a year before the FX rates even moved. The second issue is quieter. If your bookkeeping has only ever been kept in pounds, every dollar transaction converted on the day with no native dollar ledger, then that year-end retranslation step we just talked about tends to get skipped entirely. The balance is set at old rates, the gain or loss never appears, and your accounts and your tax return end up wrong. Let me show you that second one with real numbers, because it's the one that people don't necessarily see. Say you invoice a US customer $100,000. On the day, the rate's 125, so it goes on your books as £80,000. By your year end, the rates move to 130. That same $100,000 is now worth about £77,000. So there's a real loss sitting there, about £3,000. Here's the efficient way of doing it. You retranslate the debtor down to £77,000. That's the FRS 102 step. The £3,000 loss goes to your P&L and flows into your corporation tax computation. At 25%, that's about £777 off your corporation tax bill. Accurate accounts, lower tax. Now here's how the same transaction is dealt with incorrectly. The debtor stays on the books at £80,000, overstated. The loss never appears, so it's missing from both your account and your tax computation. Your profit is overdeclared by £3,000, and you pay tax on money you never actually made. The single question worth asking your accountant: did you retranslate my year-end foreign currency balances at the closing rate? If the answer is vague, the step probably isn't being done. The good news is that unless your currency exposure grows large enough, neither of the problems needs complex hedging. It's mostly set up. For the double conversion, the fix is a native currency account. Wise, AirWallex, Revolut, and increasingly the high street banks too, allow USD revenue to be held in USD rather than auto-converted by the payment gateway. You hold your dollars revenue in dollars and you pay your dollar suppliers straight out of it. Both conversions just disappear. You'll still need to move some money into pounds. Your corporation tax, your salaries, your dividends are all in sterling, but now you do that deliberately in bigger, better priced batches when it suits you, instead of letting the gateway nibble it on every single payout. For the retranslation, two things. Use cloud accounting accounting set up for multi-currency from day one. Xero and QuickBooks both hold foreign balances properly and run that closing rate step automatically into a dedicated FX account. Then have a glance at that account in your monthly numbers. A balance quietly growing is your early warning that the gap between your reported margin and your real margin could be FX exposure rather than pricing. So the bottom line, designing your treasury for cross-border flows saves you real money on spreads, but the bigger prize is a corporation tax bill that finally reflects what actually happened in your business. 2 leaks, double conversion and the missed retranslation, both fixable with a native currency account, proper multi-currency accounting, and an accountant who's set up for the work, all sitting behind a functional currency question that's worth settling first. If you'd like us to review how your own multi-currency setup is performing against these principles, the link's in the description. I'll see you in the next one. Take care.